Hello and welcome back to our podcast series on weather patterns to physical risk swaps. I'm David Kelly, your host. I bring over 30 years of experience in banking front office and risk management, along with advisory roles in regulatory compliance and model risk governance. My recent focus has been developing solutions for physical risk hazards, particularly floods. Currently, I serve as Chief Scientific Officer for MKM Research Labs, a pioneering open source innovation within the Linux Foundation. Today we're diving into the prologue of the MKM Research Labs book of the same name, which sets the scene for our journey through the world of physical risk and banking. The banking world stands at a critical turning point. Physical risk, especially flood risk, isn't some distant future concern anymore. It's here now. In fact, it always has been, threatening the very foundations this time of our banking system. And this threat, well, it's more insidious than market volatility, it's definitely more persistent than credit cycles, and more fundamental than technological disruption. Let me share some stark realities. Remember the US property market we talked about last time, valued at $52.5 trillion with $13.6 trillion in debt. Well, it's facing an unprecedented challenge. In 2024, we saw a mass exodus of insurers from coastal markets, especially the US coastal insurers, of which 42% simply walked away from Florida and the Carolinas. What does this mean in practical terms? Well, it means about $4.2 trillion in mortgage collateral is now completely exposed and uninsured, and the insurance pullback hasn't exactly been gentle. Flood insurance premiums have shot up by 58% year on year in some regions. These premium increases are pricing out homeowners and sending property values plummeting across entire regions. At the heart of this crisis lies that fundamental mismatch in time horizons we discussed earlier. Banks write mortgages with 30-year terms, while insurers underwrite policies annually. This is a classical example of what we call maturity mismatch, something traders on future exchange refer to as stack and roll, where banks lend long-term but borrow short-term through money markets and deposits. The insurance component makes this even more complex and tricky. Think about it. The property owners must renew their insurance each year, but their mortgage is a long-term agreement. Now imagine this scenario. A homeowner with a mortgage discovers that due to frequent flooding, their property is suddenly uninsurable, and as a result, completely unsellable. Mortgage holders with flood-prone properties face a tough decision. One option is what we call strategic default, which is different from defaulting because you lost your job or face some other personal hardships. Strategic default means knowingly accepting the hit to your credit score and simply walking away from the property. We saw this during the 2008 subprime crisis, where borrowers literally left their keys on the table and drove away in their, RVs, when they couldn't manage their adjustable rate mortgages anymore. So what happens next? Well, the mortgage provider gets stuck with a property that has dramatically fallen in value, but still owes money it borrowed to fund the original mortgage. The bank faces a cascade of problems. It can't sell the damaged property, can't get insurance on it, and can't even rent it out because it's not safe to live in. Meanwhile, the bank must keep paying the debt they took on to fund the original loan, maintain the property to prevent further damage, and potentially clean up environmental hazards from flood damage. These ongoing costs create a growing financial black hole on their balance sheet. In the industry, we call these toxic assets, impossible to sell, expensive to maintain, and representing a complete loss of the original loan value. And these strategic defaults, well, they're already happening in flood-prone coastal areas and river basins across Florida and the Gulf Coast. This time disconnect reminds me of what led to the 2008 banking crisis, but with one crucial difference. Those complex mortgage-backed securities could at least be sold at some price, even a steep discount, but physical risk creates an inescapable trap. No fancy financial tricks can separate a property from where it's located. While banks eventually traded toxic assets in 2008, properties in flood-prone face permanent worsening damage with no way out. The mortgage asset doesn't just lose value once, it keeps losing value with each flood, creating perpetual drain on capital. Even worse, banks have no reliable way to revalue these assets, leaving them unable to accurately price the risk, predict future losses, or determine how much capital they need to set aside. Physical risks isn't just hard to see, it's a financial hole with no bottom. Flood risk is tied to the unchangeable realities of geography, weather patterns, and infrastructure, and the risk of banking loss is tied to individual property values, flood resilience, and outstanding mortgage debt. The traditional bank risk management playbook offers no solutions here. Our banking systems are sophisticated when handling market and credit risk, but remain primitive when dealing with physical risks. The tools, models, and frameworks that worked well for traditional banking risks just don't cut it for this new challenge. Yet, within this crisis lies opportunity. The same forces driving insurance companies to retreat could spark innovation in risk transfer, valuation, and resilience investment. When properly directed, the banking sector's capacity for innovation could transform physical risk from a threat into a frontier for new banking products, improved risk management, and sustainable property finance. The science team at MKM for physical risk has designed a framework to bridge the gap between the scientific communities studying flood potential and the financial experts assessing impact on banking assets. The MKM framework is a transformation approach that connects the academic-driven scientific research, banking mathematics, property-level analysis, and systemic risk management. The framework primarily focuses on flood risk, though we plan to expand it to other physical hazards. It helps capital markets practitioners understand flood risk measurement and control in finance, and creates a pathway to implementation across multiple academic disciplines. Looking at the UK specifically, we can see how flood risk creates measurable drops in property values. Properties affected by flood sell at, on average, 8.14% at a discount compared to similar properties without flood risk. For very high risk areas, that discount jumps dramatically to 31.3%, and high risk homes see 50% slower price growth than properties in safer areas. So let's examine MKM's three-pillar framework for addressing this physical risk crisis in banking. The first pillar is, and always is, in the risk parlance, risk identification, which goes far beyond just mapping flood zones. MKM combines diverse data sources to identify systemic vulnerabilities across regions and markets. We analyze shifting precipitation patterns that show more frequent flooding and unpredictable events of greater severity and longer duration. Our approach correlates weather data with land features to spot emerging risk zones that traditional models miss. Most importantly, we map banking exposures against these hazard zones, revealing dangerous clusters of mortgage assets, as an example, in vulnerable areas. This pillar also tracks insurance market dynamics in real time, monitoring where coverage is retreating and premiums are surging. Unlike conventional models, MKM identification framework directly connects physical events to financial outcomes, creating a clear pathway from weather events to mortgage portfolio impacts. As Johnny Matimore, our CEO, puts it, quote, "Risk identification must connect the dots between seemingly unrelated domains, from atmospheric physics to balance sheet mechanics, creating a unified picture of exposure that breaks through traditional banking silos." Unquote. Flood risk and insurance pullback create an exposed mortgage market, where property owners face devaluing assets and full financial liability. Current vendors' solutions often have proved ineffective, mainly because they focus on geographic risk without incorporating the financial impact models that banks require. So the second pillar in our systemic solution, anchored by the ISDA-backed physical risk swap. So if PRS, physical risk swap, is a new financial instrument, a comprehensive approach to standardizing, pricing and transferring physical risk. The FINOS model governance layer ensures that risk models meet rigorous standards, critical for market confidence. The FINOS open architecture creates an ecosystem where data and models can be shared across institutions, promoting transparency and collaborative improvement. At the foundation is the Common Domain Model, or CDM, which standardizes data definitions across weather, property, and financial domains, essentially creating a universal language for physical risk that all stakeholders can understand. So the third pillar shows the path to systemic recovery, beginning with insurance recovery as capacity returns to the market. This leads to sustainable property markets where values reflect both the risk and resilience. The resilience in investment component is crucial. As we better price the impact of flood risk, it creates financial incentives for meaningful adaptation measures. Efficient risk transfer represents the market's maturation, where physical risk becomes as tradable and manageable as other financial risks. The elegance of this solution lies in how it connects historically separated domains, meteorology, hydrology, property valuation, insurance, banking, creating a seamless pathway from weather data to financial impact. As the Association of British Insurers has noted, quote, "The future of property insurance depends on our ability to accurately price physical risk and transfer it efficiently across the financial system. The difference is, from our point of view, we think the capital markets know how to do risk transfer just a little bit better." Our framework is designed for practical implementation using existing market infrastructure and regulatory frameworks. By leveraging established capital markets architecture for a new purpose, it offers an innovative yet achievable pathway forward. The approach increases capacity for underwriting such risk by working from capital markets under ISDA and FINOS, which provide a collective legal and data framework. On this foundation, the industry can build models that accurately cost flood risk and transfer it through new derivative instruments, specifically, you name it, the physical risk swap. The efficiency of risk transfer will enable more confidence around underwriting hazard risk and its impact on current assets. With capital markets technology that understands how to manage derivative type exposure, the increased capacity will lead to lower insurance premiums. The critical benefit for society is the drive for more effective connection between resilient investment and lower mortgage and insurance costs. As I said before, quote, "Wouldn't it be nice if the mortgage provider, insurance underwriter, and local government spoke the same language based on a common data?" Crazy, I know, but we have to start somewhere, and all great journeys start with a single step, unquote. The stakes couldn't be higher. The integrity of our mortgage markets, the stability of our banking system, and the resilience of our communities all hang in the balance. Join us on that happy note next time as we continue to explore this fascinating frontier of financial innovation. Until then.